Hello everyone and welcome to this presentation on the CFA Level 1 exam for June 2014. In this presentation, we look at Reading 55, Understanding Fixed Income Risk and Return. We'll be making several videos on this reading, and this is the first video of that series. We are making these videos in response to somebody's request made on YouTube. Do let us know if you would want us to make a free video for a topic of your choice. In this video, we define, calculate, and interpret the Macaulay duration. In subsequent videos, we continue our focus on learning outcomes B, C, and D of the curriculum and look at the modified and the effective durations. We explain why effective duration is the best measure of interest rate risk for bonds with embedded options, and we explain how different factors such as a bond's maturity and coupon affect its interest rate risk. Before we start discussing the Macaulay duration, it's a good idea to have a general understanding of duration. Duration measures the price sensitivity of a bond to benchmark interest rate changes. Now, what's a benchmark? The answer to that depends on the kind of duration that we're talking about. There's yield duration, which measures a bond's exposure to changes in its yield to maturity. Examples are the Macaulay and the modified duration. We also have curve duration, which measures a bond's price sensitivity to changes in benchmark yield curve. An example would be effective duration. It is important to remember that for all duration measures, factors other than interest rates are held constant. Let's look at Macaulay duration now. Macaulay duration is simply a weighted average of the time to receipt of the coupon payments of the bond. The weights in the weighted average are simply the present value of the coupon payments divided by the bond's full price. Whenever I say bond's price in this presentation, I mean a bond's full price. Now, this is a fairly complicated definition, but it will become a lot clearer when we'll work through an example shortly. The important thing to remember for now is Macaulay duration is measured in time periods. For example, it's measured in years. Now, why is Macaulay duration important? It turns out that Macaulay duration has a very important characteristic. It can be used to immunize a bond portfolio from interest rate risk. Now, as I said earlier, Macaulay duration is measured in time periods. Let's say a Macaulay duration is of 7 years and our investment horizon is also 7 years. In that case, let's say the interest rates change. Let's say the interest rates increase, then we'll have higher coupon reinvestment income, but the bond's price will fall. It turns out that the higher reinvestment income will be exactly offset by drop in the bond's price. However, it's important to note that there's an underlying assumption which says that the interest rates change only one time and there's a parallel shift in the yield curve, which means that all the short-term and the long-term interest rates change by the same amount, and this change occurs prior to the next payment. If this assumption does not hold, then Macaulay duration will not immunize the bond portfolio. Now, how do we calculate Macaulay duration? It's calculated using this rather complicated looking formula, but our example on the next slide will make things a bit easier to understand. Let's look at what all these variables mean. I is defined here. It's simply the period. N is the number of remaining periods to maturity. PMT sub I is payment in the ith period. R is simply the yield to maturity per period. Little t is the number of days from the last coupon payment to the settlement date. Note that if the settlement date is the same as the coupon payment date, then little t is 0, and this formula will greatly simplify. The uppercase T is the number of days in the coupon period. It could be 6 months, it could be a year, it could be quarterly. Now what we're doing here is we are taking the present value of the coupon payment using this term, multiplying it by the period here, and weighing it by the bond's full price. Now let's look at an example. Suppose we have a 2-year bond with a yield to maturity of 10% annually. The coupon rate is 8%. $100 is the principal amount. We use the 30 by 360 convention to count the payment dates, which are semi-annually, March 15th and December 15th. And the settlement date is May 27th, which is between the two coupon dates. This is the formula again for Macaulay duration. Now let's see, little I is 1 to 4 because it's a 2-year bond and interest is being paid twice a year. So we have 4 periods, which makes n equal to 4. Payment 8% annually, which means $4 every period. 5% every 6 months because it's 10% per year yield to maturity. Little t is 72 days because we are using the 30 by 360 convention, which means we have 15 days in March, 30 days in April, and 27 days in May. Uppercase T is 180 days. It's a 6-month bond payment, and we need to compute the bond price. This table uses the Macaulay duration formula. We saw on the previous slide that I goes from 1 to 4, which are the number of periods here. N equals 4. Payment is $4 every period, and in the last period we get the face value of $100 back. R equals 5%. T equals 72 days, and uppercase T is 180 days. If we look at the second column, time to receipt, we see that 1 minus little t over capital T equals 0.6, which is the terms here and here. Present value corresponds to the term in the square brackets right here for the first period, and similarly we have the other 3 periods. Bond price is the sum of the present value of the coupon payments. The weights, which corresponds to the present value divided by the bond's price, is computed in this column, which is simply the cash flow, present value of the cash flow in first period divided by the bond's price. We get this amount. And similarly we have the computations for the other periods. The weights add up to 1 as they should. And then we have time times weight, which simply means that we take the results from this calculation, the present value of the cash flows divided by the bond price, multiplied by 1 minus little t over capital T. Now 1 minus little t over capital T is coming from the columns here. We multiply it with the weights and we get these numbers. The sum of this column is 3.37, which is equal to the Macaulay duration per period. Now we just got the Macaulay duration as 3.37 expressed per period, which is 6 months. To annualize, we simply divide the Macaulay duration by the number of payment periods in a year. So we divide it by 2 to get 1.685 years. Thankfully, there's a simpler formula to compute the Macaulay duration, which is right here. All the terms have the same meaning as in the previous formula, except that we have a new term in this formula, C, which is coupon rate. If we plug in the numbers, you will notice that we get the same answer, 3.37 in 6 month terms, as we got above using the more complicated formula. Now this brings us to an end to this presentation. We hope that you found it useful. Please let us know if you would want us to make videos on a specific topic. Thanks very much for watching, and we wish you the best of luck on the exam. Thank you.